Welcome back to Growing Quality, and in this video I'm gonna take you through my analysis of S&P Global. Now, in my opinion, S&P Global is one of the most stable and consistently growing companies in the world. And by the end of this video, my goal is for you to understand why I think so. Now, let's get started by looking at what S&P Global actually does. Because their business is divided into 5 segments, with the first one being the indices. So this one you might know through the S&P 500 or the Dow Jones Index. Now we also have mobility, we have the commodity insights, we have ratings, and we have market intelligence. As of May 2023, the company completed the sale of the engineering solutions segment. And what we know of S&P Global is that they offer various products, mostly regarding financial markets or financial efficiencies. Now, S&P Global does this through software solutions, and these software solutions are mostly in the form of subscription models or periodically billed. Now, what is good to know about S&P Global is that the two biggest segments by revenue are the market intelligence side and the ratings side. And especially the ratings side of the business is important to S&P Global, as this is the highest margin part of the business. Now, why is that? Basically, companies come to S&P Global and they want to get their debt rated, because with rated debt, it's cheaper as they get lower interest rates. Now, what S&P Global does is that you have to pay a certain percentage of the total debt as the price for getting the debt rated. And after the initial rating, you have to pay S&P Global in order to sustain the rating. So they keep track of your company and they see what you are doing. Now, this is not the most work. And as they keep billing you for it, that's where the high margins come into play. Now, the company does a really nice job at breaking down every segment. And due to this, we know that the operating margin for the ratings segment of the business is 65%, or was 65% in 2023. Now, the ratings side is somewhat cyclical because we know that during good markets and low interest rates, companies are more interested in taking on debt. So when the Fed started rising or increasing interest rates, this segment of the business has somewhat fallen off. Now, does this mean that the ratings business has had a sharp decline? Well, somewhat, more or less, because in 2021, revenues for the ratings business were about $4 billion, and in 2022, they declined to $3 billion. Right now, it has somewhat come up back again in 2023 to $3.3 billion, but you see the trend here. Due to the increase of interest rates, the revenues have dropped, and with it also somewhat the margins. But still, a 56% operating margin, that's quite a bit. So the biggest segment of this company in terms of revenue is the market intelligence side of the business. And for the market intelligence side, the company has done a merger in 2022, or the merger was completed in 2022 with IHS Markit. Now, in my full report, this comes back a lot because it affected the numbers quite a lot. Why did it influence the numbers so much? Well, the merger was valued at $44 billion. So it was a very, very large merger. And the company did take out a lot of debt in order to complete it. They issued a lot of stock. So this has affected a lot of numbers. And working out how to stay efficient and regain operating margins from it is challenging, but they know they can do so because with the takeover, IHS Markit actually had higher margins than S&P Global. So this is of course a very positive thing about the merger, but it was a big one. So they are currently working out how to all complete it. They are running ahead of schedules in terms of making it all efficient again, but it does leave some room for improvements. Okay, so it's fine that we know it's market intelligence, but this is actually the Capital IQ platform. And what is the Capital IQ platform? Well, if you are familiar with the Bloomberg terminal, this is a competitor of it. So now that you know the business segments of S&P Global, I'm going to quickly take you through the executives. And I'm going to do this very quickly because I know it's somewhat boring. But after that, I'm going to give you a bull argument, a bear argument, and my conclusion about the company. So let's go through it really quickly. So starting off with Duc Peterson, he has been with the company for almost 13 years now. And before he joined S&P Global, he was actually the chief operating officer at Citibank. So we know he should be quite good at his role. Now, after Duc Peterson, we get to Ewout Stenbergen, the CFO, or actually the old CFO, because he has left the company in order to go to Booking Holdings. Now, why do I still mention him? Because I'm talking a lot about 2023 numbers, and in 2023, Ewout was still part of the business, so I thought it was good to mention him. As Ewout left the business, Christopher Craig, or Chris, became the interim CFO, and he has been with the company for a long time. So he joined in 2010 when it was still McGraw-Hill. Now, going on, we have Adam Kanzler, and Adam is the president of S&P Global Market Intelligence. So what we see here is that we have S&P Global as the big overarching company, and then we have all the different segments with their own executives. Adam Kanzler being the president of S&P Global Market Intelligence. Now, Adam doesn't have a long tenure at S&P Global yet because he used to be president of financial services at IHS Markit. Then we have Martina Chang, the president of S&P Global Ratings, and she has been with the company for a very long time, or about 14 years. Then we get to Saugata Saha, the president of S&P Global Commodity Insights, Edward Tavernier, the president of S&P Global Mobility, also again an executive that came from the merger with IHS Markit. Then finally we have Dan Draper, the CEO of S&P Dow Jones Indices, and he actually came from Invesco. Now he is on a lot of boards, but he joined S&P Global from Invesco about 4 years ago. So let's look at the growth of S&P Global, because we can see that in 2022 to 2023, revenues increased about 12%. And I think this is the best picture to give here, because in 2022, the merger with IHS Markit was completed. And from this merger, the company gained about 3 billion in revenues. What we can also see is that this has had a lot of effect on the subscription revenues, as they gained about 90%. Okay, so then let's go to the balance sheet. And what we can see here is that we have a lot of goodwill on it. Now, this of course comes from mergers, and mostly the merger with IHS Markit. If you go to the balance sheet of 2021, the goodwill there is not as big. This is really just from that takeover or that merger. Now, what else do we have that stands out? That's the long-term debt, because that's quite high at 11 billion right now. Once again, it's due to the merger, and I already told you that this was gonna come back a lot. Now, once again, like I also already mentioned, if you look at my complete analysis of S&P Global, I have a document that's about 16 pages long, and there it comes back even a lot more. Okay, so then let me tell you about my bull argument. And that's for their highest margin segment, the ratings part. Because if you think that that will decrease in the coming decade, I think you are quite wrong. I think companies will take out more and more debt as we have a debt fueled economy, and that debt has to get rated. So then your question might be, why is that necessarily good for S&P Global? There are other companies that do this, so they might just go to the competitors. That's where you have to get a bit of a idea of how the debt rating markets work, because due to the way that the debt is rated and the consequences of it, we know that companies will not go anywhere besides S&P Global and Moody's. Now, there's a third player in the market. It's the big three, they name it, and that's Fitch. But let me explain this to you. Because if companies get that debt rated by S&P Global and Moody's, they actually pay a lower interest on that debt. Now, the cost of getting that debt rated is about 7 basis points, and this also is for Moody's. So if you combine the two, it's about 0.14% of the debt to get it rated. That's the price. Now, as a result, the interest on the debt goes down. So at the end, you pay less purely because you get the debt rated by those two companies. One is fine, the two of them is even better. Both S&P Global and Moody's hold about 40% market share each. Then Fitch has another 15%. So 95% of the debt rating market is controlled by those three companies. And you can say, okay, but then let's go to a cheap competitor. Well, the interest cost is going to go up because the debt rating is not as reliable as it is with S&P Global or Moody's. So if you have a big debt you want to get rated in order to make debt load cheaper, the interest rate lower, you simply go to one of those two companies. There's no way around them. So that's not going to change anytime soon. And that's one of the biggest bull arguments of this company. Because once again, in 2023, operating margins for the rating segment was 56%. In 2021, when debt ratings were at their highest, it was even higher at 61%. So, yeah, that's quite good. Okay, so then we have one bear argument I'm gonna give here, and that is that the company is mostly relying on increasing margins or doing takeovers in order for big outperformance of the S&P 500. Now, S&P Global has absolutely outperformed the S&P 500 by a wide margin, but in order to continue doing so, the company has to increase their margins because, as we just saw, revenues rose about 12% year over year. And this is due to being in a lot of quite mature markets. I think the company can do so. That's not really the point here. The point here I'm trying to make is more so that in order for big outperformance of the S&P 500, they are dependent on increasing margins. So if we look at the chart here, we can see that with the candlesticks, we have S&P Global, and the orange line, that's the SPY over a 5-year period. And we can see that S&P Global has somewhat outperformed the S&P 500. This is just the last 5 years. If we look at it at a larger time frame, that margin just increases a lot. But let me give you my conclusion, because I think once again that S&P Global is one of the most stable growing companies out there. I think they can outperform the S&P 500 by a wide margin over the coming decade, and I think they can do so by increasing their margins and doing tuck-in acquisitions. Now, what you should not expect of this company is some 30% growth year over year. That's not this business. That's why you have smaller companies that increase their revenues by far more than S&P Global does, because S&P Global is getting relatively mature in comparison to those companies. However, they are by far not done with growing. And with the merger with IHS Markit, they have found new runway of growth. And by combining the two companies, they can restart that process of improving margins, but now with a 3 billion boost in revenues. So I hope by going over my analysis of S&P Global, you now know what to expect of this company, and maybe it interested you, maybe not. I have a full document, a 16-page document about S&P Global, which I'm planning to release in the not too distant future. So, if you're interested in that, stay tuned because it's coming, and I hope to see you next time.